Good evening, guys. Got a few people joining up.
Nice.
You tagged everyone, right? Yep. Okay, perfect.
I assume the post will be on the TSDR trading account
Yeah,
or
I'm sending them out right now.
okay.
Mm. It's posted up.
Okay.
Excuse me.
Awesome. I'll repost it as well.
Wonderful. Mm.
All right, let's do it.
All right. Hey,
Awesome.
welcome everybody. Thanks for joining in. We'll get some more people as we go on, but we've got the recording started. So thank you, Hamid, first off for joining us. We've been doing interviews for a couple of years now, and I'm incredibly excited because we haven't had someone who participates in the market solely the way you do. So first off, why don't you kind of tell us what that is, what your activity in the market looks like?
Sure. So like a little bit about my background is that like my background is software. I sort of grew up loving software in general, went to school for software development, started a software company. So I had a software company for a long time, sold it in 2020, and I've been an investor for much of that time, actually, even during the time that I had my software company in the stock market, and then I started another software company about 3 years ago called Savvy Trader. So, like my background has been in software, but I've been investing for a long time as well, almost 30 years now, which is kind of crazy. It's just it feels like I'm getting very old.
Yeah, you look great.
Thank you.
uh, so yeah, investor. So for example, we've interviewed traders. I think a lot of the people who at least my following, Brocco's following, in our group are traders. So what do you think the difference is, or in your experience in your 30 years, what have you noticed as some pros and cons maybe of the difference between the two?
You know what's funny is that for the 30 years I've been investing in the stock market, I just considered myself a trader, but it turns out like trading traders have a very like very specific definition of what. So um, I'm not a day trader by any stretch. I invest for the long term. I'm generally looking for companies that I consider to be like great companies that I speculate that they're going to be much larger in revenues and profits and so on in 3, 5, 10 years from now. And that's kind of like the time horizon that I'm looking at. And today's price is relatively good price or great price. Usually I avoid what I consider super overvalued companies, that sort of thing. So when I started the software company that's all around investing, I called it Savvy Trader, not knowing that the word trader kind of like referred to people who are constantly turning investments and maybe even day trading. So when I was pitching people on Savvy Trader, a lot of people would be like, "Well, I'm not a trader, I'm an investor." Like I was like, "Yeah, that's what I do too." But like when you sell, you're sort of trading one investment for another. That's what
Yeah,
that's what investing is. You're always trading at some point, but it's just a duration of time. So,
100%.
uh, yeah. But anyway, That that's the way I have been investing from the standpoint of like long-term perspective.
What are some of the challenges, or I guess most tumultuous times that you've experienced? Could just classic bear market downturns, or maybe something more personal, some decision that you've made along the way. But yeah, some of those tumultuous times throughout your trading career.
Yeah, yeah, investing. So in my 20s, I was investing in the dot-com boom, and like everybody else in the late 90s was doing incredible. I think I may have put in like $5,000-6,000 into the market, and at one point I had like close to $100,000, and I was like in my 20s, I thought like I was doing so incredibly well, and then the dot-com bust happened. And that taught me a lot of lessons around valuations mattering. Like if a company is valued at $1 billion but has like $10 million in revenue, that's not a good or no revenues, that's not a good thing, right? Like because that's a classic example of a company that's overvalued. It doesn't matter that there's a lot of hype around it. If things go bad, if things go south, those companies crash hard, and oftentimes you lose 95, 100% of your money in those type of investments. So I learned my lesson, lost the vast majority of that 100,000, went back down to less than my initial investment even. And then I slowly started investing again, but this time around, from the early 2000s, I decided to sort of buy companies based on sort of like looking at it from the perspective of, is the valuation of this company a good valuation, based on its revenue potential, growth potential, profitability? Does it have enough cash to survive? All of those type of questions were being asked now in my head as to when I was looking at a potential investment. And initially, I was thinking, I want to be diversified in 10 to 20 different stocks. So I would like force myself to pick a bunch of stocks, and that strategy changed later on. But going back to answering your question, so there was the 2000 bust that happened. There was the 2008, 2009 bust that happened as well from the housing market. The effects of that were that like great companies all of a sudden were being
Yeah.
valued at half price. You could buy Microsoft in 2009 at half the price that it was trading in 2008. And it's not like it was overpriced in 2008. Like the companies like Microsoft and Amazon and Apple and all these companies were actually like great companies that were like the market had seen the dot-com bust, so they weren't like getting overpriced in 2008. But because of the housing bubble crash, the entire stock market crashed in 2009 as well. So all of a sudden you could pick up great companies at half the price that they were trading at in 2008. And it turned out that didn't last very long. They went back up to sort of like their pre-2009 prices within a year. So that was a great time to invest. And I happened to have most of my income from my software company at the time. So I ended up sort of double downing on some of the investments that I was making in 2009. So I benefited from that sort of downturn. And then individual stocks that I've invested in have taught me a lot of lessons in terms of like companies that I start getting very interested in. Oftentimes, it's because the price of the stock has gone down and is on this sort of like downward momentum that ends up keeping going, right? Like there's so many examples of that I have. Like in 2012, when Netflix announced that they were going to split off their DVD business, all of a sudden the stock price crashed by like 70%. I started buying it, but it continued to crash. It just went down to like down another 50% after I started buying it. And it just blew my mind that people were like, the company had not changed. It was just as strong as ever. It was adding subscribers every quarter. It was just incredibly strong company. But the market all of a sudden, because of this one mistake that they said that they were going to separate out their DVD business, which they then reversed a couple months later because the market reacted the way it did. Uh, you could pick up Netflix all of a sudden for 80% off, right? And so one of the lessons I learned is that like as I was buying and it was going down, I just kept buying more and more. And I learned to sort of like buy slow because
Right.
one of the things that happens is the momentum carries in that same direction oftentimes. So um, similar sort of thing happened with Facebook Meta in 2022.
Yeah.
It crashed and I started buying in the 200s and it just went all the way down to like $90 a share, and I just kept buying more and more as it went down. Again, the story repeats itself with Robinhood. I started buying in 17, $18 a share, and it went all the way down to like $7 a share, which again blew my mind because at the time it was $7 a share. They had over $7
Yeah.
in cash. Um, so there's lots of examples of that where you can buy great companies at like what I consider to be great prices. So I that's been my investment style, and I've done really, really well over the past 20 plus years. Um, and I talk about investments with my family members, with my friends. I'm like constantly talking about stocks, and they kind of want to know what I'm doing. And eventually, I was like, wait a second, I wonder if there's a product that like allows you to share your investments with people and have them be notified when you make trades.
Yeah.
And it turns out that there isn't such a product out there. There wasn't one. Um, so I created it. Being a software guy, I created Savvy Trader, which allows you to sort of follow someone's portfolio that has decided to share it on the platform. So as the creator of the platform for 3.5 years, my portfolio has been public. My portfolio was the first portfolio to be public on Savvy Trader, and it's free to subscribe to. And thousands of people are subscribed to my portfolio and can see exactly what I'm buying, what I hold right now, and how well my investments have done over that time. So when, like in the first 6 months after the launch of Savvy Trader, my portfolio was down like 15%, and it was all public, like I couldn't hide it. It was just everybody could see that, it was down. Fortunately for me, the S&P was also down right around, 12 to 15%. So I was doing just as bad as the S&P, but then once things started to recover in 2023, late 2022 and 2023 and 2024, um, my portfolio just has crushed it and is now up over 400% since then. So in the
Pretty.
three and a
That's
half,
impressive.
yeah, in the 3.5 year period. So yeah.
A couple things. How many portfolios, I guess, are on Savvy Trader right now?
There's hundreds of portfolios. So the idea behind Savvy Trader is that like people who are like influencers in the investment world and have a following can actually share their portfolio on Savvy Trader and get paid subscribers from people. So
Okay.
like from their community, right? And instead of just talking on Discord or whatever, like, oh, I'm buying this or I'm buying that, and I bought it at this price, but then sharing the data the next day or whatever. So like you don't have really a third party validation of price points. On Savvy Trader, the way it works is when you share your portfolio, we take the prices at that moment that you share your portfolio. We don't care what you bought it for, and we start tracking the performance from that point forward.
Yeah.
And anytime you make a trade, you tell us what trade you made, and we make the trade at that moment's price. So the
Okay.
performance of the portfolio is based on when your subscribers could get notified and potentially, if they wanted to copy a trade of a investor that they like, they would only be able to copy it at the moment that you put in the trade into Savvy Trader, because before that they don't know about your trade. So we take the performance from that moment as opposed to, like if you bought it yesterday and you're telling Savvy Trader today about like, oh, I bought it at $5 less per share yesterday. Well, it sort of doesn't matter. We're using today's price at the moment that you tell us to determine the performance of the portfolio. Um, so the performance of the portfolio is actually based on third-party
Yeah.
verification, meaning Savvy Trader is verifying the prices at the moment you're telling us, because it's a virtual portfolio, and the performance is real for that virtual
Yep.
portfolio, if that makes sense.
100%.
Yeah.
Very, very, very cool. Yeah, we've got your portfolio here just posted in the chat. Okay, so Hood, by the way, I vividly remember when it was $7 and $8, hearing you say that it was trading below the cash that they had. And this was an account, and at that time is when I started, tweeting as well. There's an awful lot of Robinhood screenshots on this platform. And
Right.
it's like the almost like the classic phrase of the most simple investing strategy of look around your house, look around your life, what are the products you use and invest in.
100%.
And I'm sitting here looking at my Robinhood account, wondering, hey, what should I buy?
Right.
And it's like, oh,
And it's staring you at the face in the face, right?
right. And then and anyways, now it is over $100 stock. Do you want to walk through a little bit of kind of that journey from $17 to 7, up to 20, back to 12, up to 40, back to 20, and then up to 100?
Yeah, I mean, like, when I started getting interested in Robinhood, it was because of like how so the GameStop thing had happened just like within the previous year or so. So there was a lot of anger, and like I kind of like was not participant in the GameStop fiasco, and I didn't have the same sort of emotional anger that a lot of people had at Robinhood. But when I looked at it, I tried to be objective, and I looked at like what they were doing to sort of like solve their problems so that they wouldn't have that whole thing occur again. So immediately after GameStop, within like 2 weeks of GameStop halting the trades, Robinhood ended up raising $3 billion so that that never happens to
Yep.
them again. And then they went public and raised another couple $1 billion as a public company. So between the billion they already had and like the $5 or $6 billion that they raised, they had around $6.5 billion of cash at one point in time. And this is this is during the time that Sam Bankman-Fried was
Yep.
right, like like running FTX, and everybody was like, FTX is going to buy Robinhood, and like it was kind of crazy to me. And I looked into FTX and I was like, I don't see any financials for this company. It looks like they've raised $2 billion. I don't really get FTX. It just didn't make sense, and there was no financials to be found. So
I
I
forgot
was like,
about that.
how is this company going to buy Robinhood? That's just not a possibility. Um, but so like it would bump up on rumors that FTX would take it, would be buying it to like 14, 15, and then like those rumors would die, and then it would go back down to like $8, $9 a share again. So several times it was doing that. In the meantime, the financials of the company just continued to improve. They were, like losing 800, $900 million a quarter. But then like it just kept getting better. It just went down like to 700 million and 500 million and 200 million, So every quarter their revenues were increasing, their costs were decreasing. They eventually actually did a major layoff. So there was this sort of like 2022 time of efficiency that like Meta started doing layoffs, and 20 maybe it was 2023. Robinhood joined in, and everybody started cutting costs, and they were like, okay, free money is done and we need to sort of like make this thing profitable. And that journey just like caused their sort of prices to go up and down quite a bit. And even as recently as April with the tariffs, Robinhood got like had a 50% price cut during the tariff thing. And I ended up buying some more, right?
Me too.
So yeah, and I never I couldn't have possibly known that it was going to bounce back the way it did. But I was like, well, at this price, I'd like to own more of it. And uh, and by the way, I keep a large percentage of my portfolio in cash for times like the tariff thing. When the market is doing a major correction, I'm like, well, the companies I like, I'm going to buy more of and reduce my cash during that period of time. And it just happened to work out so that months later, I sold it back out, and almost doubled the money in a very short period of time. So and
Um,
increased my cash position.
do you generally go for turnaround stories?
Well, I mean, like, I'm not even sure it's considered turnaround, right? Like, Robinhood was just a fast-growing company that, like, happened to go through the GameStop fiasco and it fell out of favor. Netflix was the same story. Like, Netflix didn't ever, like, go down, right? Like it didn't need to be turned around. So Netflix was just this like rapidly growing company. Everyone around me in 2012 was using Netflix, and not everyone actually, but like it was only growing within the people I knew. And I was like, well, this company is not going away. Uh, Same thing with Meta, Facebook in 2000. I think they went public in 2013, 14 timeframe. They went public at like $40 a share. Their stock went all the way down to like 17 at one point, and it just became like a ridiculously good buy. Um, and these products were just like not turnarounds. They were just, the stock was
Yeah.
actually getting out of favor. Now
Look,
there happens to be a turnaround company that I'm invested in right now. That's Bumble. Um, but Bumble is one of these examples of what I consider a ridiculous valuation. This is like, very few software companies with high margins are trading at below one-time revenue. In fact, you would be hard pressed to find one that's trading at below two times revenue or three times revenue. Their competitor Match is trading at roughly three times revenue, and Bumble is trading at like 0.6 times, roughly 0.7 times, let's say, revenue. So. And by the way, like their revenue growth and Match's revenue growth is similar. They're like both flat to down year over year.
yeah.
So there's like no reason for this company to be trading at zero point 0.6, and it just got its founder back. The founder happens to be the person that's behind both Tinder and Bumble, two of the three largest dating apps in the world, other than Hinge. She happens to be behind them, it's a great potential turnaround story, but like, and the company is profitable, by the way. This last quarter, they generated 60 million in cash flow. So profitability actually from a GAAP accounting perspective is different because they had to take a write down of goodwill. So they had this massive write down that caused them to not be profitable from an accounting perspective. But write down of goodwill does not affect your business in any way. It doesn't affect your cash in any way. It's just some asset on the balance sheet that nobody cares about, by the way. And they wrote that down, and as a result, had like huge losses for the quarter. But really, they made $60 million of cash, added $60 million of cash to their cash pile. So if you just extrapolate the 60 million for Bumble, they're on track to have $240 million of cash added to their balance sheet uh, per year. So annualized 60 million is roughly 240 million. So let's just call it 200 million for sake of simplicity. The entire company, you can buy it right now for 650 million, right? So when have you been able to buy a $650 million company or a company for like just three times the amount of cash that it's generating, right? Like that's just unheard of.
So
Um,
one thing, so you look for some of these disconnects between current, between the market perception and price,
right.
and the core business. So I guess my question is why does it take the market so long for this to occur? Like how come the market hasn't noticed Bumble? Why did it take so long? 2 years, 3 years to notice Hood. Why was
You
Meta
tell
trading
me.
at $90?
You
Um,
tell me. I have no idea why the market takes so long. But like Warren Buffett, who's the greatest investor of our time, of our generation, he has got great quotes for everything. But like, and one of his quotes is that the market is a voting machine in the short term, but it's a weighing machine in the long term. And what that means basically is that popularity wins on determining what the price of a stock is today or tomorrow or whatever. So if you happen to be able to like hype up something, the stock is going to go up. And if you can hype down something somehow because of, short report or whatever, like just the sentiment sours on it, the stock price is going to go down. But ultimately, the price of a stock has to do with its earnings potential and its actual earnings. So you can only keep it down for so long if it starts to generate profits and that those profits start to exceed like some number where, like if Bumble has approximately, 600 million in debt or like maybe 400 million in debt. I forget the exact number, but So the debt is something that they need to get rid of. But if they were able to get rid of their debt over time, at some point they can start buying back their own stock, right? So if they were buying back their own stock at a rate of like 40, $50 million per quarter, well, the stock has no choice but to go up, right? Like, and that's just assuming no one else notices and starts to buy. But like people are already noticing. Bumble went all the way down to the threes before it's come back up. So it's already up like something like 70-80% from its lows.
Are you
So
worried about competitors? It seems like a pretty okay. Well, first off, building a user base, and I know that Bumble owns two of the top three largest, but it
no,
seems
it doesn't own two of the three.
the
Match
founder.
owns Tinder, but the founder was behind Tinder as well.
You're,
Yeah.
yeah, sorry. It
But am
seems
I worried about competitors in the
yeah,
dating app space?
yeah.
Yeah, I mean for sure. But like in fact, one of my theses is that like let's say the founder completely screws up and does not do a turnaround and like doesn't turn this company around to be a rapidly growing company again. It still has $1 billion of revenue, right? And that $1 billion is coming at the expense of Match, who's their main other competitor. Right? Like so Match could potentially buy them up, right? And like not have that additional competition and add $1 billion to their revenue. And they are trading at roughly 3 times revenue. So if they could take out a competitor and add $1 billion of revenue to their revenue pool, that is worth roughly $3 billion to Match. Now, if they can get a price for Bumble that's significantly lower than a 3 billion, so let's say they get it for 1.5 billion, that's a 2x return for Match immediately because their market cap is going to go up that much, and that 1.5 billion is still 2 times what Bumble is trading at. So in the worst case scenario, in my view, and this is not investment advice by any stretch of the imagination. This is just my opinions. We're just talking as investors, but this is how I look at it. Is that in the worst case scenario, Bumble is a great potential buyout candidate for Match. Who could take out a competitor, add $1 billion to its revenue, and increase its own market cap by 3 billion.
Um, now with what is um what is your tactic then if if it takes a very long time for the market to realize that, let's say a year, let's say 2 years, let's say
Yeah,
three
one year is nothing.
Yep, 4 years. Okay. You get my point. Let's say 4 years from
Yeah.
now, then we're trading at $6, and let's say the thesis is still the same. Maybe growth at inflation rate, or something like that. How do
So
you
in
approach
my,
something like
in
that?
my view, it should be impossible for it to be trading at $6 a share in 4 years, assuming things didn't go wrong, right? Like so, my expectation is that their profitability is only going to increase from here, right? Like or at least stay the same. And if their profitability stays even the same in the next 4 years, they're going to generate uh, roughly $1 billion of profit of cash. And if they generate $1 billion of cash, that means they can pay off all their debt and still have a few $100 million of cash left over that they can use to buy their own stock. So the stock has no choice but to go up in that scenario, right? Like so 4 years, if it's still trading at $6, I think I would have lost my conviction because it's probably for other reasons. Maybe the company revenue continues to go down, maybe their profitability goes down. So there would be other reasons, most likely. But let's take Tesla as an example. I started buying Tesla shares in 2015 timeframe, and God, that freaking stock was so frustrating for 5 years. It basically traded sideways between this $150 to $300 range, and it just kept going up to 300 and dropping back down to 150, or 200. And uh, as late as May of 2019, uh, Tesla's rumors was that it was going to go bankrupt and it started trading at 160, $170 a share. This is pre 15 to 1 split. So it
Yep.
was trading at roughly $10 a share in post split numbers, in today's numbers, $10 a share. And in the meantime, what had revenues done for Tesla? It had gone from like, 5 billion to 7 billion to 11 billion to 20 billion. I mean, the revenue growth chart looked like this incredibly beautiful exponential growth. So it was clear as daylight to me that this company was just undervalued by the market. In 2019, its revenues were $25 billion dollars, and it was getting that you could buy the entire company for 35 billion. That's how low it got. Today, its revenues are 100 billion, and it's being valued at over a trillion. So more than 10 times its revenue, right? So today, I consider it overvalued, but like during that entire time when its growth was like astronomical, I was like, okay, like eventually it's going to come. And I'm a patient investor, so
Okay.
patience is the toughest thing, by the way. Um,
How do you handle that?
but as
How do you handle that?
well, at the time, I didn't, my income was coming from other sources. So like I wasn't using my investments as income.
Mhm.
And even now where like I don't have a income generating company. So, you could consider my income coming from my investments. But I think patience, like now I have 25, 30 years of like investing where I've learned that patience is one of the most difficult, but also one of the most important things in investing. So, you
Um,
just handle it.
so you just learn to develop that patience. Is that through seeing the successful results of your patience through time?
Most likely. I mean, like the more that reward ends up happening, the more like confidence you build in your
Mhm.
investment thesis, right? Like so, yeah, absolutely. And
Um,
that like sometimes I still get impatient. Like I
yeah.
bought SMCI and I ended up selling it, and largely because I just could not get behind the founder because I couldn't understand him. I mean, it was like a language barrier issue.
Okay.
So, so
Uh,
the SMCI might like explode in the next 3 years, and I'll be like, well, I tried, but I wasn't patient enough, or maybe I didn't try hard enough to understand what the founder was saying on the earnings calls.
what are some times I'm going to kind of get back kind of that first question of what are some times where you were wrong on an investment thesis and how did you approach that through the time through the period of the trade and when did you recognize and did you immediately sell when you recognized that your thesis was incorrect?
Yeah, I made during the past 4 years or so. I started making an investment in a company called Arkimoto. Its symbol was FUV,
Oh
and I
yeah.
got excited for this company because they were making a basically not a motorcycle, but a three-wheeled vehicle that was like electric based. Founder was saying all the right stuff. And it looked like it had a ton of potential, roughly with 100 miles of range, and they were targeting a $16,000 price point, which would be a like perfect vehicle for food delivery. And we were just like post COVID. It just seemed like the perfect vehicle. It could explode, right? And the company, when it came on my radar, it had already like become a $1 billion company and had a huge backlog of pre-orders. At least that's what the founder and the company was saying. And I started investing in them, and the company when I started investing in the company was around 800 million or so in market cap, and it just kept going down. And they had like 70, $80 million of cash, but they were burning through that cash very, very rapidly. And I started getting concerned that they don't seem to be concerned about their cash burn rate, and the founder does not seem to be concerned about the cash burn rate. So I started contacting him and saying like, why, like you need to like raise money now. Uh and we had these sort of like great chats, and I started liking the founder, but I also realized that from a business standpoint, he might not be making the best decisions, in my opinion. And then what sort of like caused me to pull the trigger and like start selling the FUV is when they announced a bike product. Like I don't know if you ever followed that company, but
Did
Arcimoto.
this used to be Solo, Solo? Or no, is that different?
No, that's a different.
Okay,
That they also had that was the competitor to
gotcha.
Arcimoto's was
Gotcha.
Solo. But they sort of announced this bike, e-bike, basically that was three-wheeled as well, and I was like, guys, you have not figured out how to sell the main motorcycle vehicle yet at a profit, and or at quantity for that matter. And why are you like distracted with this other thing? And when I had those discussions with the founder, it became crystal clear to me that they were too distracted and they were not going to make it. And at the time, they still had like $40 million of cash, and I started exiting my position just because it just did not make sense. And I think I lost like 75-80% of my investment in that company. That's the most recent example of one where like I lost a significant amount of money. But here's the cool thing about investing is that the downside potential of an investment when you're buying a stock at most is 100%,
Yep.
right? But the upside potential is enormous.
Yep.
As you know, like we've held Robinhood. I'm up like 1,000% on Robinhood, or 800% or something like that, and or Rocket Lab, right? So the you can afford to have some of these sort of high risk investments that go down 80-90% and still do incredibly well because the ones that there's others that can kind of make up for it and
Yeah,
then some.
absolutely. Now I'm glad you brought up Rocket Lab because that was the next one I want to bring in. With SpaceX at market cap where it is and Rocket Lab market cap where it is, you still see significant potential in Rocket Lab today.
Well, I mean, you could argue that that's why you could see significant potential in Rocket Lab, right? Because SpaceX is roughly a $400 billion company, market cap company, and it's not even publicly traded. I believe if it was publicly traded, it would easily be $1 trillion company because people would be buying up SpaceX like there's no tomorrow. Um, but let's say $400 billion company for sake of argument. And Rocket Lab is trading at roughly a $20 billion market cap, 1/20th. And it has roughly about the same 1/20th of revenue of SpaceX, if I'm not mistaken. It might be a little bit less than that, actually. But it has incredible potential because Neutron rocket, reusable rocket, is going to compete with Falcon 9. So there's that. It has a satellite business that is growing at an astronomical rate. So when you look at Rocket Lab's revenue growth, it's on here. Actually, let me share my screen real quick and let's jump into
So yes,
earnings hub.
SpaceX revenue for 2024 was about 14 billion. Rocket Lab for 2024 was about 440 million.
Okay, so 14 to 400 is like yeah, about 20, maybe 28 times or
Yeah.
something. Um, But look at this sort of growth curve, right? Actually, their trailing 12-month revenue is 504 million, as we can see here, and then they're growing at roughly 54%. And I think they can continue growing at 54% for quite some time because Neutron is coming out next year, um, and their satellite business is continuing to grow rapidly. So this company it hasn't like it's not already a mature company by any means. Now, the price at $23 billion market cap is not cheap. It's trading at 45 times revenue. So that is a very expensive stock. So in the short term, this is one of those things where in the short term, this company could easily have, and it's still trading at like 20 something times revenues. It wouldn't be cheap even at half the current price, which is kind of important to keep in mind, right? But I wasn't buying this company at these prices. I was buying it in the fives and sixes, and it went down actually from when I started buying down to like my last or cheapest buy was in the threes.
Yeah.
But I did add some more in the 20s. And uh, at half its current price, I think the valuation would be too cheap. So um, but it has a lot of potential. So if we were to fast forward, let's say 5 years from now, this is going to be a company that is going to be very, very large. The space race is very real. It's the market for space and satellites is huge, and there's going to be multiple winners, and definitely one of them is going to be SpaceX. But like who else is going to win? Rocket Lab is in an incredibly great position. They just continue to show execution perfection, almost 70 Electron launches, sending satellites to orbit, tons of satellite technology. They're basically making most of the solar arrays for satellites. They have now laser communication for satellites. Their technology uh, catalog for satellite tech is pretty complete. And Peter Beck is a fantastic CEO that's highly focused and is executing exceptionally. And then, by the way, we need an alternative to SpaceX as just a backup plan, right? Like as like besides
That
SpaceX, there needs
became
to be
evident.
others.
That became evident while the tweet fest occurred,
That's right. That's right. Where
especially.
he's like, well, we're going to turn off, or like, what did he say? Like, we're going to stop the Dragon program
Yeah.
in an anger tweet. Like, what? You can't like stop the only manned space program just because you got angry at the president. I mean, yeah, that just showed how important it was that we need a backup provider.
Um,
So SpaceX is excuse me, Rocket Lab is in a great position to be that, but it's not a cheap company anymore. Will it go up from here? It's quite possible, but if you look at it from a 5 year standpoint, it's much easier to say. Like 5 years from now, Rocket Lab is probably not going to be just a $20 billion company.
is I okay, so kind of a combination of a lot of the things we talked about. You don't swing the bat very often. I think from what I view, you're deliberate, selective, and precise with the stocks that you choose. In terms of the weighting of those positions and kind of the building into them and building the conviction over time. Is it like a Stanley Druckenmiller invest then investigate type of situation, or is it you identify this fat pitch and you decide then I'm going to build in over the course of X amount of time to 30% or 20%. I'm not sure the exact highest percentage allocations you'll do, but kind of that
Yeah, so
complicated.
so I've learned to sort of like invest over time, or increase my allocation or investment over time because oftentimes when I get interested in a stock, the market is sour on it, so it's continuing to go down. Um, but the second reason is because I learn more about the company over time, and I'm watching CEO interviews and founder interviews. Usually, by the way, I like founder-run companies. They just tend to do better and make better decisions that are long-term based as opposed to short-term. And then I love watching their interviews, seeing like how they're talking and whether or not like this is the type of person that people would want to work for. And if that like over time you sort of build more and more conviction on these type of investments, and then it's easier to increase investment. But I would say that I probably haven't put more than 15% or maybe 20% max into a single company where I dished out that much. But then like as the company's valuation goes up, it has become like as much as 35% of my portfolio in some cases. And I've reduced my position just to de-risk my portfolio. And that has been the case with both Robinhood and Rocket Lab for the past year, where I've
What
been
do you
actually
say to
selling those
someone?
positions.
What do you say to someone like William O'Neill, who much more on the revenue side of it, looking for significant revenue growth versus necessarily just the valuation by chance? For example, like I look at basically just the not just, but the revenue growth rate is probably the primary fundamental factor, as well as I think the market opinion or theme or momentum on a stock. Um,
Yeah, so I think those are definitely important things. Let me share my like screen one more time. So because here's sort of like my evaluation process. And like I built some features, or I should say, we built some features in Earnings Hub that revolve around how I actually invest. So, when we look at a company, and I got to move some things around so that I can see my screen. When we look at a company like Rocket Lab, so this Earnings Hub score, where like the market cap is 23 billion, but half a billion of revenue. This is like important to me. But like if you were just going to look at their revenue growth, well, that's a fantastic revenue growth, 54%. It seems like an easy buy, right? Like, why wouldn't you buy this company? There's momentum, everybody seems to love it, but the valuation is quite high. So, this is where I would be cautious entering into Rocket Lab today versus I don't know. Let me look at my own stocks and see if there's let's pick Google as a perfect counterexample, right? Like I recently entered Google, and this company has a price sales ratio of under 7, a PE ratio of 22, and revenue growing at 13%. It's actually a like very reasonably priced company, and it's still growing. Now, what I don't like about Google is that it's not founder led, right? So that strikes against it. I don't think Sundar is doing a fantastic job. The AI I would have a much bigger investment in Google if it wasn't for Sundar, if it was being run by Sergey or Sergey or Larry Page, because I suspect that their AI strategy would be significantly better than it is. But
Similar to
on the other
Apple.
hand, say again.
Similar to Apple if Steve Jobs were alive, but
Oh, yeah, exactly. I mean, like, could you imagine Steve Jobs missing the AI boat? Like it's just not something that would happen. Like literally, before Steve passed away, like that one of their last acquisitions under Steve was Siri, and they were the number one provider of this like insane, insanely amazing AI, which was Siri, and like no one else had anything close to it. And then Amazon came out with Alexa and like passed Siri, and like Apple just like let that happen. Like, could you imagine Steve Jobs letting that happen? And
no.
then it just is not something that would have happened under Steve. And this is why like founder-led companies are great. Like here's like Meta. When I look at Meta, it just seems like an incredibly well-priced stock, growing faster than Google, 20%. PE is similar. I mean, it's in the 20s, right? A PE of 27, price sales ratio of 10. So this is a company that I really love. And I think like if I was starting from scratch today, I would definitely choose Meta as one of my investments. I might put, about roughly what I have in Meta today into Meta. So this is like a no-brainer to me in that sense. Um, but then let's look at another stock, which is like one of the traders' favorites today, which is Palantir. Um, Palantir is trading at 109 price sales ratio. This is like a perfect example of a really, really overpriced stock. Now, the company is fantastic. When you look at their sort of earnings growth, look at that. Like it's a beautiful earnings growth chart. Um, and it's growing faster than it ever has historically. But its latest quarter is $1 billion revenue. If you extrapolate that, it's like on a $4 billion run rate. But if it grows another 50% as it has in the last quarter, let's say it's a $6 billion revenue company. So when I look at a company like Palantir and I'm like, how much would I want to pay for a $6 billion revenue company? Um, you know, a great price would be, 30, 40 billion that's growing this fast. A good price, maybe a little bit more than that. But
So
once it
wasn't it
gets
also expensive though at $30 and at $40 and at $20?
Yes. Yeah. Absolutely. Absolutely. So, your point is 100% valid. And, could they go up tomorrow? Absolutely. Like I don't know what the market is going to do. I'm just telling you, this is why I don't invest in a company like Palantir today, right? So, Palantir today it's trading at a price where if it grew at 50% year over year for the next 5 years and its stock price stayed the same, 5 years from now, it would be trading at roughly the same price point that other stocks are trading at,
Yeah.
right? So in the meantime, if like they have a hiccup where like one quarter they instead of growing at 50%, they grow at 40%, and all of a sudden that shatters investor confidence, could it go down 50%? Absolutely. You know how many companies have gone through that type of thing? A great example of it would be what's that solar company that
Enphase, SolarEdge.
Enphase?
Yeah.
Yes, Enphase is a perfect company where like they were growing during this time. You could not convince anybody that Enphase should
Yeah.
not be like $1 trillion company. And then look at what happened to their price over the past 5 years. So they went all the way up to over $300 a share, which would have priced them at roughly a $50 billion market cap. And now you can buy them at roughly 1/10 the price that they went up to. So
I
they're
remember
they're
this.
down
I mean, the entire social media, everyone was all gung ho on ENPH, and it was the
100%. And during this time, I was one of the lone voices who was like, Enphase seems like a great company. It's growing fast. I love their revenue growth. It's fantastic. But you're talking about a company over here in 2022, Q4 2022. It's $720 million run rate times four. So that what is that? $2.8 billion. A $2.8 billion company should at $50 billion this is a low margin company, by the way. This is not a software company, it's a hardware company. So at $2.2 billion run rate revenue, being valued at over 50 billion with low margins is just like very, very rich, right? So it just because the stock price has gone up tremendously does not mean it's going to continue to go up. Uh, Obviously, you never know when the turnaround happens and it starts to go down, but that can happen at any time and it's unpredictable. And this is why I don't buy stocks that I consider overvalued.
So is that a form of risk management for you? Because
Yeah.
you also kind of use that as a form of thesis building as well. So is it like dual pronged to be risk management and thesis building, if you will?
Well, the fundamental thesis is that like I like great companies at good or great prices, right? Like ideally it should be a great company. In some cases, it could be a good company at a ridiculous price, and that's where I like my attraction to Bumble right now is based on it being a good company. I wouldn't consider it a great company because it's not like growing rapidly. It has a shot at becoming great again because its founder is back, and I also start watching the interviews with the founders to see like what are the cues and what are the things that they say. And the founder is talking about all the problems that the dating app industry has, including them, and is talking about very openly how their product kind of sucks right now. And the only way that you can solve problems is if you admit that you have them. So, and this is what I
Step
love
one.
about founders is like if you don't admit you have a problem, you cannot solve it. And uh, this is part of the reason why I like Bumble. It's now got a founder that is recognizing the problems, but then the price of the company is ridiculously low. And that's what makes it attractive because if she is successful at actually turning the company around and then like actually having revenue growth happen, it could explode in that sense.
Have you ever read the book Confidence by Rosa Beth Moss Cantor, I believe her name is. Um,
Mm-mm.
so she's a former Harvard professor who wrote this book called Confidence about sports teams, about corporate companies. It's around Wells Fargo, Gillette, and a variety of other stories. But it goes deep into the environments of companies and how confidence either is built or eroded within the company, and what sort of success or demise that leads to. It's a phenomenal book about kind of some of those internal company structures that
Yeah,
kind of create that. And it
that
just
sounds like a
yeah.
yeah. That sounds like a great book because I agree with that sentiment for sure. And like there's another great example of a book that it talks about Wells Fargo as well. It's called Good to Great. I don't know if you've read that book, but he highlights a handful of companies, 11 companies in that book. One of them is Wells Fargo, another is Walgreens, and
Oh yeah.
um, but yeah,
Um, okay, what today at this time in the market that we're in the AI boom,
yeah.
what are some of the most exciting things that you see occurring and will likely stick around in the future, and what are the most concerning things that you see investors and traders doing today? So both of those.
So you know, the opportunity with AI is that like there is going to be this transition where like we're going to be able to talk to our phones or whatever apparatus that we use for doing all these things, which you know, like right now happens to be the phone. And I am actually absolutely shocked that Apple has completely messed it up to this point. It'll be interesting to see what they do in September. But I'm also shocked that despite the fact that Google has all the technologies to execute on something that is far superior to what they have or what Apple has, they also have been sort of like fumbling, and they just came out with the Pixel 10. And you know, my view is that like nobody is complaining about the hardware. You know, there's like there isn't a single person I know that was like, I wish my phone had a faster processor in it or a better camera. Like no
Yeah.
one has ever said that, like in the past few years, right? However, ChatGPT has been the single biggest unlock of making your phone so much more useful than it has ever been. And as a result, I apologize. I have to put you on hold for just a second. My daughter is calling me.
That's just fine, of course. Um, Thank you everybody for sticking with you. I'll ask a few more questions, and then we'll top it off with one of the favorites that we ended with, kind of some of the goals and vision for the coming year, I suppose. For Hamid, I might have to ask for the next decade, which I'm kind of getting into. But if anybody has any questions in the chat, of course, pop in and send the questions in the chat. I would love to see what you guys are interested in. I could come up with 100 more, of course, you guys know. But if anybody has anything, first question.
So oh, sorry. Just to finish out the answer to your question. So like on the phone thing, no one's asking for faster hardware, but everyone wants better AI in their phones, right? So and fully integrated. So if Apple and Google are sort of like missing out on delivering this better AI, where like you should be able to tell your phone what to do inside the apps that you already have, like hey Siri, get me a Uber 30 minutes from now to take me to the airport. Like it should be like, do you want an Uber Black or Uber X? And it's like $70 for Uber Black or $27 for Uber X. Which one do you want? And like talk to me, like ask me questions and then get it done, right? And use the app for me, right? So if they don't execute on this, it's just opening the door for someone else to come in. OpenAI could potentially come in and do it. Grok, Elon's company, XAI, could potentially come in and do it. So these are sort of some of the exciting things. Meta could potentially come in and do something interesting. They're about to release glasses with displays for around $800. Their Ray-Ban smart glasses at 300 are already phenomenal. So if they combine these teams of like, the building an amazing AI team, executing on the hardware, they could be a formidable player that starts to sort of inch in for what's next. So that's kind of what's exciting. But anyway, continue.
What are you fearful of today?
From an investment standpoint, there is a lot of things that feel like are overvalued, but they, a with the dot-com bust, one of the things that happened is when the dot-com companies busted, it took down the entire sort of like market with it. I don't think we're anywhere near a dot-com level in bloated balloon that's about to pop or anything like that. But even pockets of overinflation busting could sort of sour the market in the short term. That I'm not fearful. We might have a small correction, and by small I mean like sub 20% correction at some point in the next couple of years. It's again, these things are nearly impossible to predict when they're going to happen. Um, like, but actual fear is probably like AI going
Okay.
rogue, and
So
but
the actual real fear is more societal. Is that the technology in a lot of the stocks that were kind of in, well, at least myself, kind of trading in, is going to be so good and so powerful that it's going to majorly disrupt our lives to the point. That's interesting. Um, uh, First question was, why is Earnings Hub so cheap? It's awesome.
oh yeah, it's a great question. So the way I have built software companies is to build a massive user base. I love like I get personal satisfaction out of like lots of people using my products. So selfishly, I want millions of users, and like you can't have millions of users without having a free product. Well, you can, but it just takes a lot longer. Like at least you got to start with something like this, and we do have a paid version that's pretty inexpensive. It's $100 a year, so less than $10 a month. But I think it's one of the best investment products out there. And I appreciate that question. Thank you.
Absolutely.
But
So
and we're not making money at it right now. The focus is on building a user base, and I've been fortunate enough to where like I've been able to self-fund it, and we're not focused on trying to eke out revenues yet. But at some point we will.
so for some reason I still sorry, I'm on I still take screenshots of earnings whisper, and I find it more aesthetically pleasing to take that screenshot from them versus your homepage, and I don't know why, but I
I would definitely want to know why. If like it's one thing we're creatures of habit. It's one thing if
Mhm.
it's habitual, but if you actually think that Earnings Whisper is better, then I definitely want to know
I
why.
only
Like
use
I
it for that
cannot stand
screenshot.
that product. Like
I
I've gone
I
to the.
only use it for that one screenshot for earnings for the day or earnings for the week. That one graphic that they put out is the only thing that I use it for, and then I use your website for everything else
So you can't even get that graphic as far as I know on their website, right? Like they have to put
on
it
their
out
Twitter.
first for you.
On their Twitter, yeah.
Okay, yeah, it's fascinating that people like exactly the way you want and then take a screenshot. Like so you can do that screenshot yourself. It's not even us doing it, but yeah, it is interesting that
I'm just
you know
I'm just letting you know, like from my perspective, because I use this. I'm a paid member of this. And I will be for ever, I suppose, unless the price is ballooned, 100x or something, I guess. But I for some I don't know what the solution is, but or if it's maybe it's just
if it ever comes to you where you're like, this is the reason why I like their screenshot better, or theirs is not even a screenshot. I think they create that separately as a graphic and put it out.
Mhm.
But if it comes to you as to why that you like that better, then definitely email me. I'd love to know.
Okay. Um, Well, I might as well just say now since I've got you here, because it takes me 2 seconds to just screenshot it, and on my screen I can't screenshot the entire week, especially on busy weeks, like weeks that Apple reports, and where everything reports. I
We So we have a little screenshot download button at the
Okay,
top right. So
okay.
if you click on that, it will download the entire screenshot for you. And we just released a feature where if you switch your filter to all, so or like no filter basically instead of the
Mhm.
most popular, it'll actually limit the number of logos that appear in each box to 12 logos per box. So it actually is might
I see that.
address some of the concerns that you have. So
I
the
see the
combination of
I see the download. Okay. Can we make it? Can you do it customizable to where I can go in there and create my own personal calendar?
Yeah, so we have a feature in there. Let me share my screen again. So if you go to the calendar view and go to the filter here, you can actually filter down to your own watch list. So if I just want to look at my stocks, so this is just like the stocks that are in my uh, uh, here's the month view of the
Mhm.
stocks that I own, right? So like you can see I own Rivian, Bumble, Meta, Robinhood, Rocket Lab, and this is the month view of just the stocks that I care about. And it's so easy to create sort of like a stock list as well. So if you just go to the sort of like my stocks and like you can add a new watch list and
Perfect.
start putting in
I can just call it September, first week of September, and then make that own customizable calendar right there.
yeah,
Essentially.
exactly. And you can just start putting in all the stocks that you want, but like literally it's that easy. And any names that doesn't appear, you can, like most of them are in this sort of like
Yeah.
popularity list because we also sort this list by popularity. So, I just created a stock list with
Yeah.
all of these stocks in it. Yeah. So,
Very cool. Well, I see. I'm a savvy trader, but I'm not a savvy. Anyways, I thought it was good fun. If you were to go, this could be the last question, or my last question would be, what are the goals? I usually ask, Bronco usually asks, what are your goals for the next year? But maybe for you, I'll have to say for the next five years or something. But if you could go back and teach yourself something earlier, it doesn't even have to be trading necessarily, but if you go back and learn something earlier that you know now, what would that be?
something that's like not very intuitive is that like what just building a business, for example, one of the things that you learn is that you could actually be wrong quite often. In fact, most of the things that I did, I considered them experiments, and like the results of those experiments would not necessarily be what I had hoped. So therefore, you're sort of like wrong on virtually like a vast majority of experiments that you do, and it's not intuitive to know that it's okay to be wrong most of the time, as long as you sort of like just learn and move on and keep doing more experiments. Because the times that you're right, it could make up for so much more. And so, think of it from the standpoint of that asymmetric return on
Yeah,
investment, right? Like most of the things as a founder that I did probably didn't move the needle at all. In some cases, it would move the needle backwards because it had a cost associated with it, right? Like maybe we were doing a new marketing campaign, or we invested a bunch of money into the development of a particular feature that didn't move the needle, right? So like all of that investment money was, and time and effort and et cetera, was gone. But then if we did something that was right, it might get received extremely well, and like all of a sudden could have 100 time or 1,000 time return on investment, right? So uh, it's not intuitive to, like you kind of think that you need to be right most of the time, and approaching things with the notion that not only it's okay not to be right most of the time, it's okay to be wrong most of the time, but like really you need to be able to admit that you're wrong and just
yeah.
move on and correct things. And the correction cost is usually not that big of a deal, so don't be afraid to experiment is what I would generally tell people. um you learn a lot,
Um,
even if you lose a little bit.
yeah, of course. That just got the chat buzzing. They loved that comment. Here's just one quick one. What are like your sell exit strategies for something? Yeah, I know I kind of gotten out of like Robinhood, but maybe something like Meta, for example. What is like an exit strategy on that? I guess.
Well, I started trimming my Meta once the price went above like three. I think it was around $300 a share. No, actually, I take that back. It may have even been sooner because as it was going down and down and further, I was buying more and more. And at some point, I think it hit like $90 or $88 a share at one point. And at that point, I was like, okay, like I know this company is going to be worth more than 80. Meta was at one point being valued at $200 billion, generating $40 billion of profits per year, right? Like it's just the math just did not work. And therefore, I was like, all right, I'm going to put an uncomfortable amount of money into Meta right now. But then once it went back above 200, I started shedding the uncomfortable amount of money that I had risked, right? But then like I've been shedding Meta for some time, and same thing with like Robinhood and Rocket Lab. So at these prices, I'm not a buyer of the stock. I consider them much higher risk. If I didn't already own so much of it, I might consider buying it, but it certainly wouldn't be 25% of my portfolio. I feel like that would be too high of a risk. But now I have taken out more than, something like two and a half, three times what I put into Robinhood, and more than two and a half, three times what I put uh, uh, into Rocket Lab, and even of Meta as well. So, all three of those, which are like my three largest holdings, are almost gravy in my portfolio. So,
And then you're
yeah,
able to, find something new eventually, right? And then compound and do that over time. Um,
yeah, that's the hope.
yeah, that's
Fingers
all,
crossed.
right? I don't think this market will cease to give opportunities over the long run. At least there's been very few periods where there's been nothing, right? Um, anything that you want to leave us with? Any final message to technical traders? Most of us are swing trading over the course of a couple weeks to maybe a couple months. So some people a little bit shorter, maybe in terms of 3 week or 3 days to a couple weeks. Um, any message that you'd want to give to some of us?
In my 20s, I dabbled with trying to sort of like do short-term trading, and what I found is that I don't have I'm not very good at doing that, and like I could not figure out a good way to consistently short-term trade and make money. If the market was going up, I tended to make money, but if the market was going down, it uh, you know. And one of the things that I've done, and I was mentioning this earlier, is that. I've asked a lot of day traders if they make, a lot of them have like long-term portfolios and then their day trading portfolio. I have a really good friend that is doing that. And I'm like, which one is making you more money as a percentage of the portfolio? And he's like, hands down, my long-term portfolio. And I was like, well, why do you do the day trading? He's like, I just love it. Like he just is doing it for fun. But I have not found a good way to be able to predict the markets in the short term. And I don't look at charts anymore. Like I should say, I've never really looked at charts, and um, I'm not speculating on the short term at all. There are times when, like the tariff thing, for example, was sort of a short term, but like when stocks that you really love and have a lot of conviction for, like 40, 50% off, you're like, it's kind of hard not to
Yeah,
invest in, you
yeah,
know. Especially if you have some cash laying
yeah.
around, which I did. I was 25% cash when that happened. And because the value of my portfolio dropped significantly, my cash actually went up as a percentage of my portfolio. So then I was like 35% cash, even though my cash dollar amount hadn't changed. So I ended up investing some, and my cash went all the way down to like 10 or 15% before it went back up.
All your stocks go down 50% tomorrow. Which one you buying first? All the current
Uh,
ones.
if all if all of them went down, it would have to be the Meta, Rivian, and Bumble.
Okay.
If they went down for no reason other than sort of like the market going down
Yep.
50% all of a sudden, yeah.
Meta first in that list.
I would probably, well, Meta is the least risky in that list
Mhm.
because they have an incredibly profitable business that's growing. And, I would say Rivian and Bumble are much higher risk because Rivian is not profitable and Bumble's revenue is on a decline slope right now. Now, they could turn that around. But if the reason the market was also going down 50% is because there's this sort of like overall economic concern, then I think Meta would probably be the safer of the bets.
All right. Thank you, Hamid. It's been a pleasure. I hope you're willing to do this another time if you want. I'm glad we were able to talk about Savvy Trader and Earnings Hub, as well as some of your insights into some of the stocks that you trade.
My
um,
pleasure. But by
and
the way, if anybody is interested, my portfolio is publicly available. It's on savvytrader.com, and subscribing to it is free. So you'll get notifications of my trades exactly when I make or when I put them into Savvy Trader, which is usually within minutes of when I make the trade. And I put in reasons as to why I'm buying something or selling something. So you can see, for example, I sold 2% of my Rocket Lab, and it's not because I don't love it. It's just to take some profits and increase my cash. I purchased 43% more Rivian here. So, like you can sort of see the reasons as to why. So all of that
awesome.
is documented trade by trade. So anyway,
Also, congratulations on the podcast Buy Hold Rant that you started
oh, thank
recently.
you.
I've watched a couple clips of them that you've posted. Um, uh, they're very entertaining, not only entertaining but insightful and knowledgeable, of course, as everybody has seen and witnessed today. So,
Awesome.
um,
Thank you. Thank you.
thank,
I
thank
appreciate
you.
that.
I'm gonna stop the recording here. All right, and I'm gonna end the Zoom. Take care. Have a good night.
Bye, everyone.